This is the air outside your house. Sometimes it's hot, sometimes it's cold. And this is the air outside your house. Sometimes it's hot, sometimes it's cold. And
what up, y'all? Let's get to it. A lot to talk about today. A lot going on in the market. A lot going on. So another episode. Welcome back.
What up?
Another episode of Market Mondays with Ian Dunlap. We got a lot of surprises today.
A lot going on.
It's going to be the first of many things that we haven't done that we are trying today. So a lot to look forward to. A lot to look forward to. Greetings and salutations. I'm not feeling the best right now, but pulled myself together to make it for Market Mondays.
That boy pulling the full game right now.
That's how important it is. Yeah, it's like Michael Jordan with food poisoning. Let's get it. Yeah, man, it's a lot to talk about. The stock market going crazy today. It's been going crazy for the last couple of months, actually. But today, another one.
Another. Ian, you there?
Yeah. And we're going to talk about some things that we haven't spoke about today. We're going to do some tech stuff that we haven't done before. And we also have a surprise that we're going to do. So, yeah, it's a lot going on right now.
I think he's there. Ian, what's up? Yeah?
What's good?
I'm getting adjusted. Give me 1 second. How y'all doing? Rashad,
I got you here twice, so I'm going to remove one of you.
No, leave one. So when I do the slide thing.
Got you.
What's up, brother?
How you doing, man?
Doing good. How are you?
I'm good. Even though you don't feel good, you're looking healthy.
That's half the battle right there.
That's half of it. Yep.
Yeah, man. I was contemplating calling out today, but no days off.
I say, yo, bro, it ain't there in your leisure. Both not here. Shout out to White Plains. Who's that? Judy, what up?
Yeah. We ready?
Yeah, we good. We good. Hold on. Let me get YouTube. I want, be on there to see what's going on because YouTube is very, very engaged. They're very entertaining. So let me just get our YouTube going. You up on YouTube already?
Yeah.
You good?
All right. So let's get it going. So before we start, we have a disclaimer. We got a disclaimer. So this is not financial advice. This is not investment advice. All investments should be researched thoroughly, independently, and you should consult a financial advisor if you would like to. This is a conversation, ideas, suggestions. So we had to get that out for the legal purposes.
Yeah.
Also, guidelines. As far as questions for our EYL University members that's on Zoom, please ask one question, one, not one with a trick at the end. Please don't ask individual stock questions. We're gonna go over some individual stocks. Try to have investment questions, and no red panda questions. Those go directly to Ian.
We got a call tonight at 9 p.m. Central, so you guys can ask.
Going live again tonight?
Yep, every week after the show.
Dope. Love it. Shout out to Mark. Mark, what's going on?
Shout out to Mark on the super chat, kicking it off early, $99.
Mark is a legend, man.
Yeah.
We learning a lot, Mark. Once you teach one of us, you're teaching all of us. So we appreciate everything you've done so far, Mark. Appreciate you, bro.
That's a fact. So yeah, EYL University, welcome. Let's get this going. Oh yeah, if you are interested in joining EYL University, we have a promo code, which is 40% off for the annual tuition, which includes all of our past webinars, weekly webinars, movie book club, and the Facebook group. That's crazy.
Yeah.
You just did it.
Yo,
talk about that?
Facebook group, the book reviews, man, they're all inspiring, man. I'm trying to tell you, like every Sunday we come together at 3:00 and just vulnerable and honest. It all has to do around business, but it's really like life experiences, man. And everybody's learning from each other. I'm learning from people. And people are just sharing and being honest, man. And it's dope, man. So shout out to all the earners that are in here. I see Serena's in here already. She said yesterday was Liddy. Yo, it was dope, man. And it's crazy because it's like it's Sunday, and in our community usually means church, but now it's like church and EYL Sundays, man. So we doing something every day, man. Shout out to all the earners that was part of it yesterday, y'all.
Yeah, shout out to everybody EYL. Like I said, I'm gonna put that in there. The code is earners. You go to the website, into the earners. We are reached 1,000, the quickest that we've ever reached 1,000. So shout out to everybody on YouTube. If you could just take a millisecond and like this video, that would be tremendously helpful for the algorithm.
Yeah, we got questions before we even started.
So
Crazy.
Ian, first and foremost, how you been, brother? How's everything?
I'm good. I'm blessed. This week is better than last. Shout out to everybody that's called, text, DM with your love. So I appreciate you all. And I hope you feel better, man.
I appreciate that. Shout out to Mark, who's going crazy in the super chat right now.
Mark, what's going on, man?
Yeah, Mark is ill. Yeah, man. Shout everybody. Last week was a trying week for everybody, the world, especially in our community. I expressed during that call yesterday how exhausting it is to try to explain this experience to people who kind of are unaware. So this week we feel a little bit better. You know, the light of change is starting to shine a little bit, but we got to keep fighting. So we all are for about equality and equity. But economic empowerment is equally important. So that's what we're going to provide tonight, y'all. So let's go.
Economic empowerment is the root of everything. So, Ian, let's get into it. The stock market has been going crazy. Today was another crazy day. I made a lot of money in Boeing. I'm gonna let people know my place. I think we should start doing this too.
Yeah.
Shout out to Mike today. We didn't make a play. We was gonna make an option play on Tesla.
Yep.
On Tesla. And I think the bid price was $8
right
at the beginning of the day. At the end of the day, the bid price was $30. So that means that if we would have put money into that option play, we would have had a 300% rate of return in 10 hours. Crazy.
Just different.
Crazy. So
man.
That was, one of the biggest things with investing. Sometimes you got to pull a gun. Analysis paralysis can leave you stranded. So that's what happened to me today. Troy?
Yeah, we shout out to Jamal. We spoke about options like we do every morning, it seems like. And he was weighing two positions to get in. Hertz, which we spoke about, and obviously everybody knows that we talk about Luke and coffee. Mm-hmm. And if you watched the market the last couple of days last week, you saw Luke and rise 113%, 114%. And so he was trying to catch that and make a call on it, and was trying to decide between the two, and ended up making the wrong call. So it was a costly mistake, but that's part of it. It happens. It's part of it. And we come back tomorrow with a lesson learned, and we move on and make it even a stronger position tomorrow. So that's part of it, man.
Yeah.
We in the game, for real.
We want to talk about Apple. We're going to kick it off with Apple. And Apple is obviously, everybody's aware of Apple. It's one of your favorite companies, but I think you wanted to do a deep dive into Apple, right?
Yeah, a little bit of a deeper dive. Let me switch over real quick.
Okay. Yeah, that Luke and coffee is crazy.
we lost on that, man.
Shout out to Jamal, man, the big gambler.
Ian, I'm gonna make the second one the host, okay?
Yeah, thank you for that. Let me know if you can hear me.
Yep, perfect.
Yeah.
All right, let me share my screen real quick. So I know normally I tell you guys what companies you should look at, but I kind of want to give you a breakdown of why more than anything. Give me 1 second so I get this adjusted. All right, bet.
There you go.
There you have it.
Thank you. I appreciate that. So Apple is the most valuable brand in the world. So I know sometimes people are like, hey, you just throw these companies out, but don't really give context as to why. So if you look at Apple, if you consider it all together, they really have 9 or 10 great companies rolled into one. So we always go back to that all-star analogy. So a couple of the businesses alone inside of Apple comprise one all-star team. But I want to walk you guys through 5 reasons really quick why Apple is the best company and most valuable brand in the world. So number 1, Everyone knows this. And we'll talk about Nikola and Tesla because they have some of the same qualities as Apple. But they've had and constructed one of the greatest corporate teams ever. So guys, write this down. It's very important who the founder or CEO is of the company. So you guys are often looking for a formula for what comprises a good company. You have to start at the top. Who is the CEO? Who is the founder? Tim Cook, arguably one of the greatest operators in the history of modern commerce. So when Steve died, for those of you who've been investing for a long time, you remember Apple had a great dive after Steve passed because people didn't know how well the company would do. Not only did he take over the reins of the company, he's helped catapult it without really any new products. So this would be the equivalent of Jordan leaving the Bulls and then Pippen then taking the team over and then going to the finals and winning. Tim Cook, should have happened. That foul that they called on Pippen on Hubert Davis, that still bothers me to this day.
That's how I know you're a true basketball fan. When you said that, right? That right there, that foul on Hubert Davis.
That terrible call. Anyway, and Johnny Ive is the one who designed iPod, iPhone, and of course, and actually the iPad was created first. They didn't think it had enough commercial viability, so they shrunk the iPad down into the iPhone, right?
And I'm glad you said, let me just interrupt real quick, Ian. I'm glad you said about Johnny Ive because he doesn't get enough credit either.
At all.
Because he's one of these guys where everybody knows Steve Jobs, everybody knows Tim Cook, but he's arguably the most important person out of this whole situation. Because without him, he's really the brainchild behind. He's a designer. So like all of this stuff that you see and like looking at a company's board and their makeup, not only is leadership important. People throw a lot of dirt on Steve Jobs' name because they said he wasn't a great inventor but he never claimed to be the best inventor. He's a leader. But a leader's only as good as the talent. It's like a coach. Yes. Phil Jackson couldn't be Phil Jackson if he didn't have Kobe, LeBron, Mike, Scottie Pippen. So the talent, it's not just good. Don't just look at the CEO of a company. Look at the talent of the company. And Johnny Ives is a perfect example of that because he's actually a genius.
Yeah, and we saw what happened to their stock when he decided that he was going to leave the company. So, I mean, that tells you how important he was and is.
And we always talk about assets, and I've even been stressing to Xander how important assets and reliabilities are since we've been partnering together. But the designer, Johnny, Apple is still living off the creations that he made to this day. So for my Rockefeller to all my New York East Coast family, Steve would be like Jay-Z. Tim Cook would be like Dame, shout out to Dame, if he was a little bit more level-headed. And Johnny Ive is like Kanye, Just, and Bink rolled into one. Without that sound, Rockefeller would not have been Rockefeller. So you need those three together, which is why you always hear about the Holy Trinity of investing or the Holy Trinity of founders. That's really important. So when you have that team together, that gives the foundation for a long product run, right? So the team is incredibly important. Then second, brand loyalty. We can't talk about this enough. Maybe we can do a whole deep dive on this, but I need to express to you, like, Apple is a religion. So you have to see that the people, and I'm going to ask this to you and everyone listening, do you have your iPhone in your hand more, or do you have your Bible in your hand more? Everyone has their iPhone.
Yeah, it won't even be close. My Bible's in my iPhone. Absolutely.
So the Apple Store, the way they constructed it is like a church. The loyal fans, us, we are the congregation. When we have to put our credit card information into iPhone to buy apps, which we'll talk about in a second, that is the collection plate, right? And then, Lord forbid, somebody come with that green bubble talking about how their phone is better. Look how we go crazy. So it's the same structure. Steve was the messianic figure of the brand. And when you marry all that with the design, plus the product being better, brand loyalty is key. Apple is the most valuable brand in the world, right? So then let's go to the third point, the Apple Store. The App Store is the biggest app store in the world. So think of it like this. The App Store is like the only record label that matters for creators of apps. $50 billion in sales last year. So the App Store alone, if you took it out, it'd be a Fortune 150 company on its own.
Yeah. That's important to know about the apps too. It's something that we actually learned, is that how much Apple makes off of somebody putting an app. So like, I think, what is it, 30%?
30%.
They take 30%. So if I put an app in the store, if my app does well, they taking 30. If it doesn't do well, they taking 30% off the rip. Like, I don't think a lot of people understand that.
Nope. And I think Apple will probably frame it like, we're giving creators, they're going to spend it a chance and a platform to reach a bigger audience. And I saw Ryan said that he liked Samsung better. I could make an argument, and so could you, Ryan, that Samsung has had better designs over the last 10 years. But that equity, this is why I always talk about holding things for a long period of time. The equity that Apple built from the 90s through 2007 and being the first, so they were the first smartphone ever, pays off in their favor. So it's like, it's when rappers come out and be like, I'm better than Jay-Z, but you don't have a reasonable doubt or a blueprint, or even if you like best of both worlds, right? So it's about who occupied that space first, which makes a huge difference. So imagine if one record label had 2 million artists underneath their umbrella. That's the equivalent of the App Store. It's a point that I always brought up. My dad used to always say, the person with the gold makes the rules. They got $207 billion cash on hand. And the great part, go ahead.
I said, just in case, right?
Just in case, to either reinvest in the business, buy back shares, hire the best in the world. I don't think they will, but maybe acquire Tesla. That's a possibility, right? If the stock comes down, there's a lot of companies that they can acquire. And I know you're going to talk about the deal that they're working on as well. Apple is. Yeah. But if the economy is ever in a bad space, like how it was in March and April, the company can weather a storm. So ladies always, I love my analogy. So if your man come to you in a recession and say, hey, I got 2 million in the stash, you're going to be like, okay, I'm going to sit this one out. Everything's good. We have some reserves on hand to be okay. This is the corporate version of that. So if a good company is about to go out of business, or they can acquire the assets or the talent, they have enough money on hand to do so and be able to reinvest into the business. And then this is one of the things that my friend Azim pointed out to me yesterday. He was like, man, if you value the AirPod business alone, the AirPod business alone is worth $40 billion. So you combine the $207 billion they have on can, just sitting in the bank, which a lot of it is tucked away in Ireland, so they don't pay as much in taxes. Mm-hmm. The App Store, which is like the biggest record label for creatives. You go back to the founding team, and Tim Cook is eating off a lot of the assets and things that Steve Jobs put in place and Wozniak put in place. It's the reason why I always stress to you guys, buy this business. This would be like the equivalent if you could have Shaq in 2000, Jordan in 92, Jordan in 96, and Kobe in 2001. That's what they have under one company. Not headquarters and hedge funds love them. Headquarters is amazing. Hedge fund thinks it's a great buy. And so when you guys are asking, do I think it will drop or will the value go away? Absolutely not. The 200 billion is not going away anytime soon.
That's going to be tough to get rid of. I think, a couple things, like you said, the fact that they have diverse products, right? So they started out as a computer brand, but now they're a full-fledged phone company. You know what I'm saying? Like they've transitioned so many times. They had the iPod, then they had the iPhone, then they had the iPads, and now, like you said, the headphone situation itself could be its own business, right? So like having diverse products is another strength of theirs, and also their partnerships. They've made some strategic partnerships throughout their lifespan, right? So like in the late 90s, they partnered with Microsoft, which was a rival, right? But in order to help the brand grow, they partnered with them so that you could have Windows on your Mac. And then they did the same thing when they were about to come into the headphone space, right? They got Beats by Dre, right? Yeah. They got Beats by Dre, but then they put out their own headphones. You see what I'm saying? They have some real partnerships. And then the next thing that they're going to do, which is interesting, there's some whispers that they might have try to buy their own search engine. All right, they got 207 billion. Having their own search engine now completely puts them in a race with Google, right? And they could potentially take over that space. Yeah. The thing I found out is that Google actually pays them every year. They pay him $8 billion a year to have their search engine as the #1 search engine on the iOS system and on Siri. So when you text Siri something, Google automatically pops up. Like everybody knows that. But I just found that out like recently, like, yo, $8 billion a year to make sure that Google's the #1 search engine. If they go into that space, now you don't need them. You see what I'm saying?
Absolutely.
It's crazy.
No, that was dope. First and foremost, yeah, I think that was dope to kind of kick the show off with that, because it's like we're gonna talk about stocks, but like Trapper always says, shout out to him. It's easy to just give somebody a fish, but investing is not an easy game. It's not gambling. And it's like if you're getting into this and you just want stocks, like here, buy this stock. A, it's not sustainable because now you constantly need people to tell you what stock to buy. And B, you're never going to be in a position to actually build real wealth. Like it's not a get rich quick scheme. So to actually break that down, and we took Apple because that's an obvious company that everybody knows. It's not like a foreign company. So to actually say, okay, we all know that Apple's a good stock to buy, but why is it a good stock to buy, right? So in the easiest layman terms that we did, I think Ian did a great job in like 10 minutes just explaining, like this is kind of like fundamental investing. So now you're getting an inside look of how hedge fund managers work, and an inside look of how institutional investors look. And it's like, okay, they're looking at the management, they're looking at the assets, they're looking at the product lines, right? These are all things that you should actually be looking at when evaluating a stock, not just, I heard it on the news.
Yo, somebody put it on Instagram.
Like, exactly. So appreciate that, man. That's definitely, felt like I was in university. So EYL University, I definitely felt that was right up our alley. And yeah, man, that could have been taught at any university across the board. So thank you for that, and thank you for making it understandable for everybody.
And Apple, I mean, it's fitting. They hit their all-time high today, $333. 330. I think that their market cap hit 1.5 trillion today.
The most valuable brand
in the history.
Absolutely amazing. And they're not going anywhere. So people keep asking, are they going? And Karen said on YouTube, Apple has mastered taking other companies' ideas and executing them better. Very true. Very true. But in corporate, every company is executing the same idea. It's the little touches that will make a huge difference, that will give you leverage to break through. Zoom is a recreation of GoToMeeting. If you ever use GoToMeeting, I think the user interface is not the best. If you're in corporate listening, I'm sorry. Don't cut our brand deals off with y'all. But Zoom is an easier platform to use. And I was having a conversation earlier with my barber, Charlotte John. I'm like, if Robinhood gets their fills and executions down, they're going to put a lot of brokerages out of business because it's an easier platform to use. The days of things being complicated and people still using them are long gone. So
let me just jump in before, I know we got a guest, but I know we got a couple questions, but I wanted to throw something out there, some free, I'm not even gonna say free game, but this is just something to get people to think. And I want to get your opinion on this too, Ian. Gush, G-U-S-H. G-U-S-H. You familiar with Gush?
No.
Sure. So Gush is an oil and gas, I think, ETF. Yep. Gush, 2 years ago in 2018, the stock price today is $67. Take a guess on what the stock was 2 years ago, 2018.
If you're asking me, I'm gonna say like $18.
$16,000.
Oh.
$16,000. Well, 16,000. It went from 16,000 to 68. To 68. But what's interesting about Gush is that it was $37 or $35 a month ago. So Gush is picking up a lot of steam right now, especially for short-term traders, options. People, it's a riskier play, but it's very tempting because you look at something like that. It was $16,000 2 years ago. Now it's $57, right? So now it's a lot of speculation going on, like, well, Gush, because it really still hasn't. You could look at it like it hasn't really like gone crazy yet. So how you feel about Gush?
Gush is a good trade, bad long-term investment. I'm gonna say it again. It's a good trade, bad long-term investment. So just even with that, if I'm looking at the chart and we go back, My baseline is always a 5-year. If we go back to 2015, it was at 65,500 if you adjust it. So essentially what the market is saying is that company is probably one of the more valuable companies. Don't do it. It's a good trade. So if you guys are going to make a trade short term and you're going to swing trade it, great, take advantage of it. Long term, when I tell you guys to invest in quality companies, I'm asking you this. Would you rather have one hit or would you rather have a bunch of hits where you can go on tour forever? Gush, same thing with G and US, which I told you guys.
I was just gonna say that we know some people who were personally hurt by that. And the crazy thing is the day it went up, we saw it go up to $10, right? You put up the post, listen, this will be $1.50 in about a month. And I mean, like as soon as you put it, I see the stock price drop. I said, oh no, some people don't.
Jay-Z once said, I don't know why your advisors ain't forewarn you. There's a difference between a good trade and a good investment. It's not a good investment long term. But if you guys are going to trade it or do an options play on it, you're good. But no, it is a good point because we have more volume because the people that were gambling on sports walked away because there was no sports and began trading. There's more volume in the market. So know what this is a great trader tip. Know what your big target is going to be because some people have hit 200% and 300% gain and still wanted to run to 1,000. I'm like, 200% is fantastic. Take your profit. Walk away, but Gush, long term, please. Please.
That's what you just said is absolutely right. There's nothing to bet on, so people are going into the stock market.
They betting on stocks.
That's what they
betting on stocks like it's fantasy football. And the thing about it is, so once again, invest at your own risk. But watch Gush. If you're trying to do a short-term play, next week we'll see about Gush. But
we'll be right here.
Don't say I never threw out some free jury for a short-term slide. Let's get to some questions.
And Darius, we coming to you. Unmute yourself. You've been unmuted, bro.
Hey, yo. Can y'all hear me?
What's good, man?
What's going on, brother?
Uh-oh, EYL is in the building.
Yeah. That's my boy. Darius, shout out to the book club, man. He's part of the book club. What's good, bro?
Most definitely. Now, my only question is quite simple. What I'm looking at is the time frame as far as researching long-term plays. How much time do you allocate to researching a long-term investment?
That's up to you. It depends on which one you're looking at, but you should be looking at the market every single day. That's the only way you're going to get a feel for what you should and should not be doing. Like these lessons I learned, and everyone that's ever traded can tell you this, you learn everything from losses. So even like when Tesla shot up a lot, same thing with Genius Brands Limited. We've seen that before in the futures market with crude and natural gas and volatility index. And when you get your butt kicked and you lose 25% in a day, you know not to chase certain things. So I would say I would make an hour a day. If you have not read Money Master the Game, I'm begging you to do so. The best book ever on long-term investing, in my opinion. So at least an hour a day. But if you want to be serious about it, I would do 3 or 4 hours a day. And then once you get your routine down, you don't need to do any more than that.
Appreciate you, bro.
Exactly. Definitely appreciate that one.
Appreciate it, family.
All right, Marco, what's going on? Unmute yourself. You've been unmuted.
Thanks. So
First, I will say thank you guys for the advice, your time. I got a question in regards to precious metals, especially silver. How do you guys feel about purchasing silver?
As a long-term investment or a trade?
Marco, we talking long-term?
Marco, long-term or a trade?
Appreciate that.
Long-term.
Long-term.
Silver is okay. Gold is much better. Gold is king. If you're going to pick a precious metal, you're better off with gold across the board.
I was going to say that gold, you're never going to lose money long-term with gold. Gold is standard. Like, you go to India and like they're hoarding gold. Like they give like wedding, when you get married, you get like a trunk of gold for your wedding presents and all that. Like gold is always going to be used and valued as long as humans are alive. It's been around way longer than paper money.
Mm-hmm.
Way longer than paper money. So that's my I was going to say the same thing. And if you're going to invest in something, why would you invest in silver when you can invest in gold? It's
Yeah.
like the top. Like, you know what I mean? Like, why not play at the highest level? Like, why would you want to play in the D League instead of playing in the NBA?
So I'll tell you why. If you read Rich Dad Poor Dad, one of the things that he continuously talked about was investing in silver, investing in nickel. I'm like, all right, this might be a change. He's like, it's $15. It'll be the next gold. And I'm like, all right. Until you do.
But you're comparing it to the next.
Exactly.
Thing.
Yeah.
So the thing is already here.
You're comparing it to gold, but gold is already here.
Exactly.
Yeah. So, but this is my advice to you. Research, and I want you to read probably 20 articles on comparing silver versus gold. Come back next week and tell us why gold is a better investment.
Appreciate that.
Appreciate that. All right.
We got it. You want to say?
Yeah. We got a new segment that we're about to do. We got a guest. Ian, I'm gonna allow you to introduce the gentleman and give some background on him.
So you guys know I love index investing. I think it's the simplest form of doing so. And I've been following Jeremy for about 2 years. There's not a ton of people that I love in the investing space, but Jeremy's one of them because he shows profits. He talks about the good parts of investing as well as the downside. So you guys know social media can be very tricky, but the work that he's done, I think, can help all of us. And I know some people hate index investing, and I don't know why. So I think if you get another person's take on how well it has worked for him, you'll get an observation on why it's something that you should add to the mix. So I want to introduce Jeremy Schneider from Personal Finance Club, one of my favorite people in the investing space, and actually my first time chatting with him. Jeremy, welcome to Market Mondays. I appreciate you.
Thanks for having me. I'm pumped. This looks awesome. I'm really glad to be here.
Yeah, appreciate
sure.
you.
I'll give a little bit more background. I'm doing some research. So Jeremy is the head of Personal Finance Club, big index investor, and you retired at 36 years old?
That's true. I mean, the word retired is a little bit corny because it just sounds lazy or something, but I don't have a job anymore. I don't need a job. I direct my time as I see fit. And yeah, most of that wealth came from starting and growing a company, and I sold it when I was 34. And then I've been an index fund investor before and after. I just invest long-term, buy and hold, keep it simple. And that's how I think I'm going to maximize my own wealth going forward.
All right. So yeah, we got a couple questions. First and foremost, thank you for joining us.
Welcome to Earn Your Leisure,
we
man.
appreciate it.
Yeah.
So index investing, we talked about index investing a little bit, but I know you're real big on it. So Ian thought that this would be a perfect opportunity to really go deep dive. Why do you prefer index investing over individual stocks?
So I've been listening to the show today, and like you guys are talking a lot. You talked about Apple, and you talked about Gush and the oil. And here's the thing: is like it's very, very hard to beat the market. And so if you buy an individual stock and it goes up 8% this year, but the whole stock market went up 10%, that's not really a gain. It's really a 2% loss to the market. And the sum total of all the stocks in the market average out to the market. So, if one stock is up 12% and one's up 8%, that averages out to 10%. And so when you're trying to pick stocks, you're essentially saying, I'm trying to beat the market. Because if you're not trying to beat the market, then you shouldn't be picking individual stocks. You should just buy the index. And then if you're contending that you can beat the market, it's very, very challenging, because despite being and I think you guys are extremely well-researched, you've done your homework, you're very well-read, but you're not competing against the next investor. You're competing against the sum total of human knowledge, because the sum total of human knowledge is constantly and instantly being baked into every single price of every single stock, because there's millions or billions of traders and only a few thousand stocks that can be traded on. So every single tiny little penny change is being priced, based on all the different traders, all the different algorithms trading, all the different mutual funds, all the different hedge funds. And so to beat that game is extremely difficult. Plus, when you trade, it includes, there's fees, or there's, buy, sell gaps, there's tax implications if you're selling. An index fund basically says, okay, I'm going to just admit I am not smarter than the sum total of human knowledge. And instead of trying to pick and choose a few stocks, I'm going to buy every single stock all at once. And so in the US, there's about 4,000 publicly traded stocks. You can just buy all 4,000 all at once for virtually no cost. There's a tiny, tiny fee associated with these. When you do that, you guarantee yourself your fair share of all market growth. So you own Apple, you own Microsoft, you own Facebook, you own Netflix, you own ExxonMobil, you own General Electric, Tesla, down the list, you own everything. And when all those companies grow and innovate and hire and profit and create revenues, all that is pumped right back into your index fund, right back into your account without having to guess which is better. So that's why I love index funds, because I don't want to get taken advantage of by algorithmic traders or by mutual fund managers or by hedge fund managers. I want to guarantee myself my fair share of market growth. And over long periods of time, the market goes up about 10% per year. And if you're just putting away $500 a month at 10% per year over 30 years, or sorry, over 40 years, is about $3 million.
Easy.
So you can become fabulously wealthy with just slow and steady, tried and true investing in an index fund.
So when did you start investing? I know you said you stopped working at 36 for someone at 36. So
No, he sold his company. What company did you have that you sold?
The company was called RentLinks. We did online rental housing listings. So if you wanted to list an apartment for rent, you could post it to Zillow or apartments.com or rentals.com or Craigslist. I created a site where you can post it once and it automatically feeds to 50 different sites. And then you can track all your incoming leads from renters. So it's basically a tool for landlords.
Who'd you sell it to?
I sold it to a company called Appfolio, who is publicly traded. I bought a bunch of their stock at 12 and I sold most of it at 24. And now it's at 180. Oops.
I made mistakes like that.
I still own some, and actually, like the condo you see behind me was paid for with former Appfolio stock, so it did fine for me. But yeah, so I sold Appfolio.
Yeah, my personal investment philosophy that I like is to have half indexes and then half tech stocks. But why do you think people hate indexing, even though it's the easiest thing to invest in long term?
I like that strategy, by the way. Like I actually go for the 90-10 strategy, which is 90% index funds, 10% stocks. And I like your strategy too, because either way, it gives you a chance to see both sides. And if you're as good at picking stocks as you hope you are, not you, I just mean any person, you should be able to look at your two portfolios and see that you, over long periods of time, I'm talking like 5+ years, if your stocks are really outperforming your indexes, then cool, then you can move more towards stocks. But if your stocks crash, you want to actually not ruin your retirement by not having like your fair share of market growth. So I think the reason people don't like index funds is because it sounds like it's average. They're like, I don't want average, I want fabulous growth. And it's not get rich quick. It's not exciting. It's not sexy. It's like very boring. Like you were saying earlier, like look at the market every day. I was like, I mean, I kind of do look at the market just because I'm interested in it, but I don't make trades. Like I might go years without making trades other than just constant reinvesting, because I know over time it's going to average out. And so I think it sounds like it's average. In my opinion, it's not average. There's a study that shows that over the last 100 years, the market goes up about 10% per year, but the average investor gets about 4% because of making all these mistakes, like timing the market. I just talked to a friend yesterday who's a pretty wealthy guy, but he, in the middle of the coronavirus crash, he was sure that the market was going to get worse and worse. And so he bought an inverse ETF. So he bet against the market. He bet the market was going to go down more. And then of course, the last few weeks, the market has jumped up 30%. So he got super burned. Right? And so
well, first I wanted to say shout out to YouTube. We hit another record, 2100.
Breaking news alert.
Yeah, breaking news. Shout out to YouTube. Nice. If you guys can like this video, take a millisecond. Everybody on YouTube, if you can just like it, we appreciate it.
And shout out to another breaking news alert. There's over 200 EYL earners in here right now. Shout out to University. Over 200.
So Jeremy, I wanted to ask you, and this is one of the reasons I want to highlight this, because we're not a lot of platforms online are biased. Like they only steer you into one direction, and you could really steer somebody into any direction that you want them to go. There's really no right or wrong with investing. So we talk about stocks a lot, but we realize that everybody's not going to be an individual stock participant. Yeah. So we want to talk about index funds, ETFs, mutual funds, all of those different things, and they all have advantages and disadvantages. So with the index, what are some top indexes that you personally are invested in, or you personally recommend? I mean, we know like the Dow Jones 500, the S&P. I mean, the S&P 500, the Dow Jones. But what I
thought she was gonna say Vanguard. I was like, every 50K gonna say Vanguard.
So what are some top indexes that you recommend?
Well, first to your point about there's lots of different ways to do it. I always talk about my 2 rules. Rule number 1 is live below your means, spend less than you make. And rule number 2 is invest early and often. And so if it's real estate, if it's individual stocks, you know, like you said, there's a lot of ways to do investing. But if you spend every dollar you make, no matter how clever of an investor you are, it doesn't matter because you're going to be broke. And so, you know, I think investing can be confusing to a lot of people, but always remember, if you spend less than you make and you invest that difference, you know, you just want to increase that gap. It doesn't matter if you're perfect at investing. That's the important part, is actually doing it. And don't let the fear of the perfect stop you from even getting started, right? Because it's like, oh, it's so confusing. I'm just going to spend every dollar I make. You know, that's the wrong reaction. Just get started. So, and to answer your question about the best indexes, the thing about indexes is like, there's not really better or worse. I just did a little study on the top 12 US stock market indexes over the last decade, and they're all basically identical because they all do the same thing. They all follow the market. And so there's a book that's on the 3-fund portfolio, which basically says there's only 3 things you need to buy. A US stock market index fund, which is to buy every single US stock. An international or non-US stock market index fund, which is to buy, you know, Europe, China, Korea, you know, all the emerging markets. And then the third would be a bond fund. And so those 3 kind of give you the ultimate diversity: every US stock, every non-US stock, and then the income producing bonds. And then you just have to choose your asset allocation, which is what % each. And most people usually choose something like 55% US, 45% international, and 10% bonds. That would be an aggressive portfolio for like a young person in the wealth accumulation phase.
Yeah, that's a valuable lesson. That's a valuable lesson, because a lot of times we're looking at like, listen, we're trying to get rich quick. Index funds ain't the popular way, right? Because it's slow and steady. But at the end of the day, the market's always going to grow. We know that. We're going to take a question. Steven, we coming to you. Unmute yourself. You've been unmuted, sir.
Hello, you hear me?
Yeah, we hear you perfectly.
What's going on, guys? First, I want to say I love what y'all doing. Yo, I've been looking for y'all for years, man. I'm happy y'all here.
Yeah, you found them.
First and foremost, I started investing in March. Always wanted to do it, just jump into it. Right now, I'm literally at maybe 110% return on all my stocks. So now, I know, Ian, you're not big on stocks with motors, but all my stocks with motors have me at 200%. So now my question is, I want to get into more tech stocks. So should I sell those and take my profits and go into something like Apple and something more techy?
So, all right. So yeah, he brought the airlines. You brought the airlines. The airlines went crazy.
Cruise ships.
Now you're thinking about selling that and going into tech, right?
Yeah, if you want,
basically.
Yeah, if you want safety, I would diversify, because even if you go back to episode 70 that I did on EYO, I said index funds, and everyone killed me for it, in tech. I'm no genius. I just took Buffett's model plus what some other hedge fund managers like and merged them together. So you have to get, I would say Vanguard. I'm not an affiliate for Vanguard. I don't get any kickbacks for referring them. And then I would look into either Apple or Microsoft, because more than anything, you want safety. So I'm happy that you're up 100 and 200%. And coming off these lows of the recession, you did an amazing job by executing. I will tell you this, next year won't be the same. The market is going to stabilize and you're going to hit a steady 10 to 15%, but you got a great head start. And if you combine the index with the tech, you should look at maybe about 15 to 17% return on average. You can coast clear from here for the next 8 to 10 years. So you'll be great.
Yeah. And I'm glad you said that, Ian, because it's like, even like, you know, looking at my portfolio, a couple of stocks that I sold a lot of the stocks, but some stocks that I still own, Boeing, I'm up like 220% on that. Mm-hmm. Even American Express, I haven't even checked American Express. I'm up 58% on that. I had all of the airlines. So it's like, this is a once in a decade opportunity. In March, yes. If you invested in any company in March, you're at least 50%, at least 50%. Yeah. 50 to
March, this is not typical.
Yeah. So now as the market moves regular, now you got to be either more seasoned. It becomes harder. Like it's easy to win when
everybody's winning.
Yeah, that's like a no-brainer. But now usually it doesn't work like that. It's not that easy to make 100% in 1 month. It can happen. It can happen. But
Yeah.
that was like a real.
It feels like those crypto days when it was like, yo, every day somebody's going up 100%. Like somebody.
Yeah, but you have to also learn from that crypto book. So when the bust happens, when everyone goes back to work and the volume dries up, because now the level or the playing field is now level, we're going to go back to slow gains. And the great part is like if you invest it, you're going to be making money while you're sleeping, like Jeremy said. And I want to ask you, Jeremy, when this recession happened, how did you stay? Because I was watching your page. People were attacking you too about index funds in March, and it's like, here we are, almost back to the high. So how do you stay put and not change your strategy when the entire world is screaming at you that the world is going to fall apart?
Well, I think you just have to look back in history and just, it's really hard because it's easy to look backwards and know what happened, and your brain will convince you that it seemed obvious at the time. But then looking forward, you have to recognize that it's not so easy to know what's going to happen going forward. And so if you look at the years 2000 to 2010, that was like a lost decade. The market was actually down over the course of a full decade of investing. It was down about 22%. But if you include dividends, if you're holding the whole time, you're only down 7%. But if you were reinvesting at that time, if you're putting $500 a month away during that time, you're actually up 7%. So even though the market was down 22%, you're actually up just by investing early and often. So even in a down decade, you can have made money by continually investing. And then so if you invested over that decade, that's $500 a month, that's $60,000. And if you just held that $60,000 till today, it's over $200,000. So we're only 10 years past that now. And your money has like over tripled since then because that's what happens. And so I would say you just have to like accept there's going to be volatility in the short term, but in the long term, the market goes up. One metaphor I've heard, it's like yo-yoing while walking upstairs. So you're walking upstairs and it feels like you're getting bounced up and down, but over the long term, you're going to keep making progress. And then when you look back, you've like climbed the full set of stairs, and there's still the volatility of the yo-yo, but it's like a big overall game.
I like that, Jeremy. I like that.
Yeah, it's one of the best things that a 401k provides is discipline. Dollar cost averaging is extremely powerful. And dollar cost averaging is when you're putting money in, what you just explained, on a consistent basis. And the 401k is like one of the only vehicles that most people use as far as dollar cost averaging, because it forces you, it comes right out of your paycheck. And before you know it, you have 60,000, 300,000 in your 401k. Like you didn't even realize it because you was only putting $200 a month, but you do that for 20 years. It's get rich slow. That's the get rich slow approach. And so that's one of the good things with index funds is that, if you are not, because let's be honest, I mean, we got 2,200 people on YouTube. Obviously, it would be great if everybody read every single day and watched CNBC every single day. But I mean, a lot of people probably won't, right? But that doesn't mean that you still can't participate in the stock market. So even if you're not going to be an active investor, you can have the market just working for you and invest. Like I said, an ETF, mutual fund, or an index fund. An index fund has a lot of different benefits, but one of the main benefits I want you to talk about, Jeremy, is the cost difference. Can you explain that? How a lot of people, that's why they're really big on index funds, is because you don't really pay anything and not a lot of money relative to like managed portfolios. So
totally.
How does that cost factor come into play?
So back in the day, index funds are a relatively recent invention. They kind of like first came to light around 1980, and they kind of just became really popular the last 10 to 15 years. But before that, if you wanted someone else to pick and choose stocks for you, you would put your money into a mutual fund, and what we now call an actively managed mutual fund, where there's a manager who basically is choosing stocks and making trades and making all the decisions. But that manager was working in a high rise in Manhattan or Chicago, would charge a high fee, usually like at least 1% annually of the assets under management. And then there's often another 1% account fee or something. So if you have a 2% fee, it doesn't sound like a huge number, but if you put $10,000 in a fund, that means $200 a year is going to come out. If you extrapolate that over the course of 40 years, it erodes half of your money. So the fees, half of your money is eaten away by these fees. And so if you would have had $2 million, instead you'll have $1 million. It's like devastating. And so an index fund, instead of having a fee of 2% or 1%, index funds have fees of closer to 0.1%. So it's like 20 times cheaper. And and sometimes they're even lower. In fact, Fidelity has some index funds that have 0% fee. They just decided not to make money from those and have it be a loss leader for their other products. But and Vanguard's total stock market index fund is about 0.04%. So it's just tiny fees, like so close to zero, it doesn't matter. And so if you're going to be if you're not going to be an active investor like you guys are discussing and say, hey, I just want to put my money in a 401k or an IRA, leave it for 40 years, guarantee my fair share of market growth, the fees are the only thing that you can choose that are going to have a predictive effect of your future wealth. How long the manager was working there, the Morningstar rating, the CAPE ratio, the turnover ratio, like all the stuff you can do to analyze a mutual fund has no effect statistically on its future growth, except for the fees. The lower the fees, the higher the growth, which is why minimizing your fees is so important.
Yeah, shout out to Daniel. He kind of paraphrased it. He was like, it really comes down to, you want a fast nickel or a slow dime. Shout out to Max Maxwell who put us on the game with that.
Sure. Question.
Yeah. We got Randy. What's going on?
Randy,
Unmute yourself. You've been unmuted.
Ryan.
Ryan, my fault.
Randy.
I saw his last name. Yeah.
I want to know, I'm trying to get I want to get a index fund for my baby, and I want to know what's the best way to do it that's tax efficient for when she gets ready to pull it out.
Sure. Yeah. So if it's for college, if you plan to use this for your child's college, I would look into a 529 account. It's a special type of account. The proceeds need to be used for educational purposes. It's pretty flexible. And by the way, guys, I'm not a professional. And so, I'm a serious hobbyist. And so take all this with a grain of salt and do your own research. But I'd say a 529 is the only way to really invest for a child in a tax advantaged way. Another way would just be to invest for yourself. Make sure you're taking care of yourself first. Like it's the airplane mask thing, which is if you're broke, if you're in debt, if you're in trouble, but then you're trying to give money to your kid, that's not, your kid will be better off if you're a good role model and you're financially secure. And you can invest in a tax advantage way for yourself within a 401k or a Roth IRA, and always just gift them money later. So I would say either a 429 if it's for school. I'd say your own retirement accounts otherwise. And then after that, it would just be a brokerage account. And like I said, tax or index funds are pretty tax advantageous because there's not a lot of trading. And so there's not a lot of capital gains you have to pay in taxes along the way until you sell.
Yeah, I'm glad you
appreciate that, Ryan.
I'm glad you said that, because that's something that's very true too. It's like a lot of times people want to invest from their children, haven't invested for themselves yet.
Yeah.
And, you shouldn't really. My personal advice: you shouldn't invest for. I'm not saying that Ryan's not investing. I'm just using this as an example. But yeah, don't invest for your children until you invest for yourself. It's that old. It's like you gotta be secure first before you can secure somebody else. And there's like, set rule of thumb. But I personally think if you don't have, Ian, I'd love to get your take on this. If you don't have $20,000 invested for yourself, you're really not in a position to invest for somebody else. Right?
I agree. Yeah, and also for the parents, I tell you all the time, I know a lot of you want to teach your kids about investing, but you can't teach them if you're not doing it for yourself. Like the pain and agony that I tell you guys about staying away from low float, low volume stocks, that comes from my experience of losing. Even trading, when I say, hey, limit the number of trades you take, that's from me losing. If I can go back and do it all over again, and I said it earlier, I would have taken all, and I know you're not supposed to, I would have taken all of my refund money from college and put it in Apple stock. I was in college in 2001 when the iPod got popular. Mm-hmm. Everyone knew Apple was amazing. Everyone knew Microsoft was amazing. You missed out on Google. So I get it. You guys want to pass on, because we often love our kids more than we love ourselves, but we have to start with ourselves first, and then we can pass the knowledge on from there. And yeah.
And some parents are learning with their children, right? There's plenty of apps and definitely websites you can go to, especially in education, right? We have kids that are doing stocks in 5th grade. So if there are apps and applications that you can use and grow and learn with your children. So like Shadi said, if you're not investing yourself, it's going to be tough.
But then the UTMA is another way too. The UTMA and the UGMA, we talked about that a few times. That's 529 plan, education, UTMA and UGMA. It's just if you invest for a child, but it's not tied to college, you can open like a brokerage account with their name, and you're the custodial.
Yeah, somebody was saying in the custodial account.
Yeah, custodial account. That's another way.
Frank T, we coming to you. Frank, what's up? Unmute yourself. You've been unmuted.
Well,
Frank went to the fridge.
All right, I'm here. I'm here.
I thought you went to
Hey,
the fridge, Frank. All right, what's good, baby?
I'm doing good. EYO, Ernest, what's up?
Everybody good in here, man.
So my question is about real estate stocks. So currently, mostly every real estate stock that I've viewed, a lot of them are 100% up. And so I have a few tickers that I can give you guys, but it's kind of questionable because how is the real estate market going up, but unemployment is super high? It's just not really adding up to me. So could you guys elaborate on that?
Well, I'll touch this quickly. Shout out to MG, the mortgage guy. But I was talking to him about this, and I did some research. And that's actually a really good question. He said, how is the real estate market still going up? The real estate never crashed throughout this whole time. It still hasn't crashed. Commercial real estate took a hit, but not residential real estate. And it's less inventory on the marketplace right now. That's what they were saying. There's less inventory on the market because a lot of people aren't selling their homes right now because of COVID-19. People don't feel comfortable moving. It's just like, it's a lot
too much
going
uncertainty.
on. So being that the inventory is lower, it's like supply and demand, right? So now inventory is lower than it usually is. So the people that, even if it's less buyers, those fewer buyers still have to spend more money because it's not a lot of inventory. So that's and that was really interesting because you never know how everything has an effect. And a lot of people thought this was going to affect real estate in a negative way, but actually in most markets across America, real estate has been very stable. And in some markets it's actually up. So, but ETFs are made up of commercial real estate for the most part. So that's a different play, and REITs is commercial real estate. So if you're talking about the REIT fund, that's different because I don't think we still are at the point where we're going to know how this is going to affect commercial real estate.
All right, some of these companies that have been renting out space, it's going to be tough, man. It's going to be tough.
Like Twitter, they said their employees never have to come back to work.
Right, exactly.
So now Twitter has all this office space. If they're telling thousands of employees that they never have to come back to work ever again, they don't need that office space anymore. So
and I want you guys to remember, this was not 2007. So when people are saying, I want a recession again, you're saying, well, I missed the last one. So now I want to use my plan from the 07, 08 crash now. This was a pandemic. This was a health crisis. So the factors that were in play then are not in play now. So you have to adjust and use the same determination and research. And I know some of you are upset that you missed this recession. This was my driving motivation in 2008 to never be caught on the sidelines again and study like crazy. So when this one happened, I was already ready and prepared. But this was not a residential or a commercial real estate crash. That market kept chugging along. But like Jeremy's pointed out, I pointed out before, if you're in indexes and you're buying every single month, a lot of the upside, and even with companies like McDonald's is one of the biggest real estate companies on earth. Look there, Apple, one of the biggest real estate companies on earth. So you may have to get a little bit creative, but the exposure that you want to get the upside, I'll tell you guys all the time, and I told you in episode 70, an index fund is like an all-star team. So if you give me LeBron, Kyrie, Kevin Durant, Giannis, listen, you can pick whatever team you want. I know I'm gonna do well. The indexes are the same thing. You can tie in and get some of those gains you want from the market on the real estate side there.
Appreciate that. Appreciate that question.
Okay. I got one more question if I can get it real quick.
Frank, we gotta keep it going. We love you, bro.
Gotta stick to
Guidelines.
Peace and love. Peace and love.
Appreciate that, Giovanni. We see you on YouTube. We got 1,000 likes on the video. Appreciate that.
Appreciate everybody.
We love y'all.
If you could like the YouTube video, please like the YouTube video. It helps out a lot. Thank you.
Yeah, Giovanni, be ushering in them likes, man.
And I want to tell people another pick that I made. Well, I did one stock play last week, so I'll let you guys in on that. Once again, shout out to Mark. Good guy. He's been tutoring me on options. We're gonna talk about options on here, but we just have to. I don't know if that should be an episode because I feel like and I think it should be a prerequisite that you have to watch all the other episodes first
to get to that point.
You can't, if you don't know stocks, you're not going to be able to trade options. It's a more advanced conversation. It's kind of hard to explain that to somebody that doesn't really have the fundamental.
Now, let me jump in and say this as a person that trades. The biggest mistake every trader makes is not holding stocks long term. You cannot pass on trading to your child. If you get maimed or killed, Lord forbid, they cannot pick up your double crossover moving average strategy and provide for your family. Please. I don't care if you get 1,000% return. Like I've known some people that get 3,000% return. And I want to ask Jimmy about personal finance stuff here in a second, but I've known people to make 1,500% and go below the money. You're back at zero. So you put in all this work to have the gain. Just be careful that you need a long-term portfolio first, and before you go into trading, I am begging you, do not do it the other way around.
Ian, it is 9 o'clock, which means that it is the earnings time. So we're going to talk about 3 earnings calls that are coming this week, and one IPO that we didn't talk about last week, but kind of came out, and I'll get into that in a sec. So the first one is tomorrow Chewy. Hopefully you're familiar with that. It is a food brand, and based on everybody staying home and a lot of people shopping in the supermarkets every single day. Should be interesting to see what their stock does. We're watching that for Tuesday. Thursday, we are watching Adobe. We spoke about DocuSign last week, but Adobe is also in that lane, and they obviously have a large user base, so that would be interesting. And it's funny that my boy Jamal is here because the other one we're going to talk about is Dave & Buster's. Their sign is Play, and Dave & Buster's is interesting because it's one of those things that it tanked. It was down to $4 when everything closed up in March, and it's slowly creeping back up. It's up to $28. I think it had a high of 48 this year. It is something that he's been talking about for months. Like, yo, Troy, you gotta watch it. You gotta watch it.
Watch Dave & Buster's. For everybody that always wants some free candy, Play. PLAY.
Exactly.
Watch that because the economy is opening back up, and now we're making it from stay-at-home stocks to come back outside stocks.
Yeah, so that's something that I'm gonna let him talk in a second. Well, I'm gonna let you on mute in a second. And then we had an IPO, Warner Music Group. We always talk about how music is supporting us, and we've been growing on that. So it IPO'd at $25, and it went up 25% since then. So obviously, streaming has gone up. A lot more people are home, and Warner Music Group is home to some of the biggest artists in the world, Ed Sheeran and Cardi B. So just keep an eye on that, on those 2 stocks. Jamal, what's going on? You unmuted, man. Unmute yourself.
What's going on, fellas? How you doing tonight?
See what I did for you there, man? See I threw you that alley-oop, bro?
Yeah, I appreciate that out there, Hey, listen, I should have hit Ian earlier today before I hit, Lucan. I would have 50-50, but I'm still playing with some house money, so it's all right. Sometimes.
All right.
I want to say that. Hold on. We got to jump in. There's no such thing as house money. That's your money.
That's true. That's fair.
There's no such thing as house money.
I haven't sold it yet, so I'm still in it.
Okay.
I can't let it go yet. But as it goes for Play, it was actually brought to my attention. I had a friend of mine that bought it at about $6, early on, and I kind of traded it a little while. They're still under their, 52-week highs, closer to $50. But again, it's one of those outside plays, right? I got a 6-year-old son. I've had birthdays there. There's sports that are there. There's a lot of entertainment, and I think there's opportunity to. If it goes down, I would probably buy a little bit more. They have also had another funding round by Jefferies, which is a large capital investment company. They put about $100 billion behind them. So that's one of the reasons why I felt like that they were safe. But that's a position that I'm willing to hold a little longer term to take advantage of that position, right? I mean, they're still 50% off of their 52-week high, right? So that was important for me.
Good.
Ian, one second. Yo, Jeremy, I know you here. These are the rules, right? Whenever you want to chime in, you jump right into the conversation, my brother. All right?
Okay, thanks. I appreciate it.
Go ahead, Ian.
Xander asked me this weekend, can we go to Dave & Buster's? I'm like, it's not safe yet. But as far as the stock, it has jumped up a lot. Jamal, I would tell you around $39, start to look to take profit on it at that particular price. If you let some more run, great, but I would probably take half of it off at that particular price, and you'll be happy there. And
absolutely.
Getting it at 6.
Absolutely. Appreciate that, fellas.
Appreciate you, bro. All right, hopefully I get this right. Kiss you, we coming to you. Unmute yourself, you've been unmuted.
All right, thank you. It's Kisu.
Kisu.
There we go. All good, all good. You did a good job. Hey, thank you, first of all, for y'all coming and giving this information out. I appreciate it. Ian, I'm Red Panda member also, and been giving some good tips. So I'm just curious as to about this Hertz thing. I bought the Hertz at 81 cents just because it was 81 cents. And you know, of course it worked out, but I'm just curious as to how does that go in regard for a company's stock price and value when they're doing a bankruptcy like that?
More important, let me ask you a question. So, you know, last week, and I always mention, if you get into a trade, your exit has to either be based on time or an exact price. Right. What is the exit price?
I didn't have it. I just bought it because it was 81 cents.
Okay. Now you got in at the lowest 40 cents. It was at 80. Great.
81.
Yeah, you got at 81. You did great. That's amazing. I need you to plan your exit. You're up in a tremendous amount right now. I need you to either decide to hold it as a long-term investment, or if you are going to exit it as a trade. My personal thoughts on Hertz, even before this, Hertz high was at $63 5 years ago. The high of this year was 19. Any stock below 20 to me is not a great long-term buy. Brother, you grand slam, game 7. Start to look to where you should take profit.
Right. But I'm sorry, but my question is how does the bankruptcy affect a stock? Because I thought that it would, like, you know, basically just become worthless.
I think, well, this is my take on it, Ian. Yeah. The same reason why you said, we asked you why you brought it, you said because it went to 81 cents or 81 cents, you got it, right?
Yeah, you got 81.
That's why you brought it. So you got to figure, you're not the only person thinking like you. What we're seeing right now in the stock market reminds me a lot of the crypto days, where it's moving heavily on speculation and really gambling, really. Like a lot of people's really gambling. And it's like Hertz, obviously bankruptcy is not good, but since the stock price dropped so much, people look at like Hertz still going to be here no matter what. So this is an opportunity just to pile in. So much money piled in, and then it just went up like 500%. But speculation is playing a major part in the market these days.
Yeah, and I think when people hear the word bankruptcy, they think automatically like this business is closing. And it really doesn't mean that all the time, right? There's different types of bankruptcy. And I think what they did, they filed Chapter 11. Was it Chapter 11?
I think so.
Chapter 11. So they're just going to restructure their debt.
I'm not sure.
It's not going out of business. When the country opens back up, people will still need to rent cars once they start traveling. So after they restructure, I'd be interested to see. It was just too risky for me to do it. But if you got that 81 million, congratulations.
And even with this, once again, in 2014, Hertz was at $97. A lot of this is hedge funds also taking profit. A lot of it is. So when they're exiting, retail traders are getting in and it's bouncing up. It is a great trade. Hertz long-term is not a great, I'm trying to help as much as I can. You hit a home run at 81 cents. If they make another book on investing, you should be in it for the entry. But I will tell you, please look to take profit. Please look to take profit on it. Jimmy, you have any thoughts?
Yeah, I think you're right that there's just multiple types of bankruptcies, and the type that they're going through has not closed the business and has not pushed the stock to zero, but it is already priced into that stock. So everyone knows that they're going through this bankruptcy, and that's why the price was so low, down from $80 to 80 cents or whatever. But I think to answer your question, Kisu, which is we can't know what the stock's going to do in the future, given that there's this bankruptcy going on right now. You know, clearly it has been bad for the company, but we don't know if it means they're more likely or less likely to fully go under, or if it's going to go up more. When it clears, it's kind of already priced in, because what we know about that bankruptcy is already priced into the current price of Hertz.
Ian, you have some questions that you wanted to ask Jeremy, right?
Yeah, Jeremy. So I'm big on the no debt model as well. So I hate any kind of credit card debt, any kind of personal debt. I know you talk about living underneath your means. Why do you think people don't like? Can you also tell them that living under your means does not equate to living like you are destitute? But why do you think most people do not like living below their means? And what are some of the things you do to bring that to reality?
I think it's tough because, and I think it's awesome what you guys are doing, which is just talking about it, but most people don't talk about it. We don't talk about money at home. We don't teach it in schools. And so most people just are products of their environment, and we see borrowing money to get a car and putting money on credit cards and like just all this marketing constantly. And it's like the billboards and the ads and the, you know, the TV and everything. And so you're just kind of a product of that very, you know, capitalistic society or whatever. But I think, like you said, you can be more happy if you don't immediately bury yourself in debt and then just have to make payments to the bank your entire life. If you can just get out of that system, spend less than you make and invest the difference, then you kind of, like they say, there's two types of people, like those who understand compound interest and those who don't. You either pay it or you earn it. And so if you're like in the earning side of compound growth, then you're making all this money and you can live more like happily. And if you're paying it, then you're kind of stuck. And so why don't people do it? I really just think it's just like years of tradition, and I'm almost honestly kind of conspiracy theory on why it's not being taught in schools. Because
Go
I
into
think,
it, please.
okay, well, I basically think like, you know, giant corporations in our capitalistic society benefit from normal people working every single day and making payments to the bank every single day. And they like when you consume, like they like when you go buy a new car for 30 grand and you can't afford it, because then you're committing to the next 7 years of your life working at a job and paying that off, right? If you spend less than you make and you keep the money for yourself and invest the difference, it's better for you and worse for the corporations. And so I think that's why, you know, the lobbyists are trying to keep financial education out of schools so that, you know, normal working class people keep, you know, keeping that system going forward. So I really like, I'm almost conspiracy theory on why we're not teaching.
No, I mean, it's interesting that you say that, because, and this is the thing with EYL, we bring people on from all different backgrounds, but a lot of times people have the same message. And so we just did an interview with Mike Son. Mike Son is a rapper, and he's a criminal justice activist. Yeah. So he was talking about, you know, we talked about the prison system and a lot of different stuff. And he was saying, as far as like, you know, society, you don't really have to technically have a middle class, but you kind of need a poor class to have the rich class. And it's like what you just said in different words were kind of similar to that as far as the education piece is concerned. Financial literacy, by freeing people and teaching them financial literacy, now some people are not going to benefit from that. Some people are actually profiting from people being financially illiterate. Yeah. Because if you know the truth about credit cards, if you know like payday loans and all of these things, and you don't get yourself into this trap, the companies that's making money on this, they're not going to make money anymore. Yeah, shout out to our brother Wall Street Trapper. He said it very clearly. Like, is the lion going to teach the water buffalo how to get away? Is he? If he does, he'll never be able to eat, right? So I'm never going to tell you how to get away. I'll keep you in the trap. We got to realize that's what we're in. And that's kind of like why we started Earn Your Leisure, why we were teaching financial literacy in the summers. It's because we knew it wasn't going to be taught, but we knew it could help our people gain economic empowerment. Yeah, for sure. Definitely. For sure. Kimberly, we coming to you. You unmuted. Unmute yourself. Uh-oh. Kimberly went to the... Kimberly
forgot that second step of unmuting after they unmute you.
Next.
All right, this is an important one. Adrian, I am coming to you. Adrian, what's going on? Unmute yourself. You've been unmuted.
Thank you. Can y'all hear me?
Adrian, you know why I came to you?
Because I've been trying to get into the Zoom.
Because you told me yesterday you've been trying to get into the Zoom for Market Mondays as it hasn't been working. So welcome. I don't know why it wasn't working, but welcome to Market Mondays. Adrian, what's up?
Hey, thank you. Yeah, I was troubleshooting today, but I figured it out.
There we go.
So I have a question. So I got into stocks probably last year, and I just bought my first stock when I got into it, which was Snap. And I just thought my logic was, hey, I got a Snapchat account. Let me just try it. It was, you know, cheap. When I got into it, I think it was like $10 or whatever. But now it's at its highest. And so you guys have been talking about like knowing your price and knowing your exit strategy. And I didn't have one going in. So I wanted to know your thoughts on like, do you think Snap has potential to be like a Facebook or something? Like, should I make my exit strategy now when it's at its high? Because I'm afraid I don't want to lose.
Okay, I'll ask you this. Do you use Snapchat more than you do Instagram?
I actually don't use Snapchat anymore.
So I will potentially have you consider if you don't even use it, to maybe walk away from it and then reinvest those profits into a company that is more valuable. So you got another great, so even when you guys make investing decisions and it may not be the best timing, of course, I mean, you're double. That's great. That's absolutely amazing. But if you're not even a user of that product, and I'm not a huge fan of the invest in what you buy because there are great companies and there are okay companies. Snap is okay. They're making progress, but I think if you put that capital into something else, to go back to Jeremy, if you don't know, go index first. But I think Facebook is better in the social media space. But tech overall, I like Apple a lot more. Hit an all-time high. Adobe we didn't talk about, but Adobe was also on a watch list that hit an all-time high today. There are a lot of companies that are better than Snap. They may be more expensive, but you'll sleep better at night. And that fear that you have now, you won't have. Like, I don't have the same jitters around Apple when I look at the market as I would a Snapchat or a GE or Ford.
Okay, thank you.
Thank you.
And I might add that think about diversification. I don't think you should have your entire financial future tied to any single company. You know, if you think 10, 20, 30 years down the road, is Snapchat going to be the one company that has made your retirement? Almost certainly not, right? And so I would think about what different companies, even in different sectors, maybe like auto, maybe transportation, maybe shipping, maybe oil, whatever, you know, you want to be diversified. So if tech does bad for 10 years, then, you know, maybe shipping does really well or something, because you can never be sure which exact industry even is going to do great. So try not to put all your eggs in one basket and diversify.
Yeah, it's just one of the, like that was my first one I bought ever. I have others, but it's like the highest one right now. So that's why I was like, should I keep it or should I sell it? But thanks for that information.
Appreciate it. And then also,
Appreciate you, Adrian.
We didn't talk about yet, stop loss. You can always have a stop loss on it. So like, that's like if you at 10 and it's like, all right, it's at 20, so you doubled your money and you don't really have a crystal ball. So you can't tell if it's going to go to 30 or if it's going to come back to 10. So it's like, all right, you made 100% profit. What are you comfortable walking away with? You might be comfortable walking away with 80%. So now you set the stop loss at, or set sell a sell order, not stop loss because you didn't lose any money. A sell order, you put a sell order in at $18. So what happens is that if the stock goes from 20 to 18, it automatically triggers the sell order, and now you sell it at $18 and you walk away with 80% profit. You lost 20% because you didn't sell it at the peak.
Lost a lot more.
You could have lost a lot more. Yeah. So that's something that people should utilize as well. Not only the stop loss, we talk about the stop loss, but what we haven't spoke about is sell orders in advance. You can put a sell order in advance and it'll automatically trigger if and when it hits that price.
Yeah, and that automation process is key, right? Because a lot of times, especially if you at work, you might get that news late and it's already done. Yeah. It's like, wait.
And I'll say this, for those of you that are up 40, 50, 100%, and this is your first year investing, my Lord, you don't know how good you have it. Like, this is so rare. It's like you playing 8th grade basketball, you score 120 points in your first 2 games. It's like, it's great. This is not going to last forever. You took action during one of the roughest recessions and probably economic disasters that we've ever had. This is not going to remain the norm. So don't, a year from now, be upset with 20 and 30% gain. You are off to a fantastic start.
We got a lot of hands, so we're gonna go lightning round right now. Jeremy, Ian, feel free to answer as fast as possible. Let's get these questions in. Tonda, what's going on? We come to you. Unmute yourself. You've been unmuted.
Hey, can you hear me?
Yeah.
So I've been day trading and I do invest long term. I know how you feel about that, Ian. But my advisor handles that fund. I have a solo 401k. So I know, like you said, this is not going to last forever. When it slows down, will I at least be able to get like 20 cents off of, of movement to be able to capitalize?
It depends on what you're trading. So be very careful, however, because one of the things that I don't like in trading stocks, so me trading futures, I look at the same ones every day. When you trade stocks, you have to actively hunt which ones to go after, but there'll be enough volume in, especially on the tech side, that you'll be able to invest in, but be very careful that you don't have a watch list of 25 things. I think you should master one sector, whether it's tech, biotech, or a place that you can consistently get gains. And honestly, the slower moving ones on the trading side are better for you because you're not going to have as wild of a loss. The time that we are in now is just like the storm has passed. During the storm, people were able to get a lot, but you'll be able to get 20% movement. But I would tell you, limit your trades to maybe to about 5 or 7 a week so you don't burn through a lot of your cash there.
Thank you, Tonda.
Thank you.
Janet, we coming to you. Unmute yourself. You've been unmuted.
Hey guys, I'm gonna ask it quick because I know we have a lot of questions, a lot of time. So this is for Jeremy. I know you said you retired early, so I was wondering, are you living off of your investments? And if so, what do you do? Like for instance, in March, if it hadn't bounced back, like what would have been your strategy for, living off?
Yeah, so there's this thing called the safe withdrawal rate, which means based on the historical volatility of the market, you can basically take 4% of your invested assets per year and never go broke. And so right now, my invested assets are about $3 million. So 4% of that is $120,000 per year I can take out. And that's as adjusted for inflation and irrelevant of where the market currently is. So it's based on your starting number. And so if it goes from 3 million to 2.5, I could still take the 120 and live on that. And then it will have time to recover over the next 10, 20 years before it goes to zero. And so that's basically what I do. It's a little bit more complicated because I have a little bit of real estate investment that provides income too. So I just basically take a little bit off the table every year and let the remainder keep growing.
Yeah, that's the Monte Carlo simulation, which you're referring to. That's right on the money, 4%. They teach you that. You learn that in the basics, 4% of an investment of a retirement account if you want to make sure you don't deplete it. So, yep, that's right up.
Yeah, I remember you told me that.
Yeah,
like years ago. You're like, yo, if I get to 3 million, I can live off 120,000 for the rest of my life.
Yeah, and for those of us that are doing well, Jeremy, how do you not excessively spend and stay within your budget? Because I know a lot of people, when they make a certain amount of money, they get to 3 million, they're like, I'm gonna get a big house. Especially guys, I'm gonna get a Lamborghini, I'm gonna get 3 cars. How do you stay within budget and feel comfortable staying within budget knowing that you could buy more? Because I think that's the thing that people have to realize, that after you make the money, it's harder to keep it in our possession.
Yeah, I think that's true. Like I had obviously like a big jump, but I think anytime you get a raise, there's always lifestyle creep and there's always the next bigger house. There's always the next nicer car. There's always the next trip. And the way I think about it is you'll never ever be rich until you want less than you have. If you always want more, you can have 3 million in the bank and be broke, like a few more blocks towards the ocean from where I live, there's a $3 million house. I could spend every penny on my house and I couldn't even afford the tax bill on that house, and those aren't even like, they're really big houses. There's $30 million houses another few miles like that way. So you just have to like be comfortable with the fact that there's value in like being happy where you're at and knowing that there's always going to be the next Joneses you need to keep up with, but you'll be happier if you just are comfortable with where you currently are.
Yeah, they putting the jewelry up. That was a gem. That was a gem, Jeremy. Appreciate that.
Where do you live? California?
Yeah, I live in San Diego.
Okay.
Okay, sweet.
Living a good life, San Diego.
It's nice.
Best cities in America. Judy, unmute yourself. You've been unmuted.
Peace. This is Mr. Judy. I have a question about fuel cell companies. How do you feel about fuel cell companies? Because some of them are coming in like really low, but they're like getting major backing from the actual Exxon and all those kinds of other companies.
Ian, you want to talk about that?
I haven't done any research on that sector. You have a ticker? I can take a look at it for you very, very quick.
The fuel cell energy is one. Give me a second. Let me get the ticker.
I think FCEL. I think low float. No, fuel cell in 2000 it was at $7,830. It is now $2.71. It's a good trade. Definitely not a long-term investment. And then in 2015 is at 146. For my traders, this is put option heaven. But as a long-term investment, no.
All right, thank you.
Appreciate you, Judy.
Oh, I wanted to tell, before we forget, I wanted to tell people the trade that I made last week. So I brought XLK, which is a technology ETF. I did an options play on that, and I brought it. It's at $101. I brought an option for January 2022, I believe, January 2022 for $135.
Yeah.
I think it's a pretty.
Look at it for you.
2022. You got some time.
Got 18 months.
You got some time.
Yeah, 18 months.
Yeah, that was so. My play last week was DraftKings. I saw it drop down to 35. I said, all right, I got to get some more. Somebody's asking about DraftKings. We put it up on Instagram. I love it. We said it's a tech stock that involves sports and gambling. I love it. So that was my play last week. I doubled my position in DraftKings.
I have one more question for Jeremy, and then we're going to do, thank you guys for tuning in. I'm going to do a stock club giveaway tonight for one person. Jeremy, what is the greatest piece of advice you can give someone tonight if they are terrified to invest in index funds long term?
Yeah, I think in general, just don't let perfect be the enemy of good. I think so many people are worried about getting it exactly right, or there's like listening to this show. If this is your first day ever tuning in and ever hearing about money, there's a lot going on, guys. Like this is this is like a lot this is a big pill to swallow for your first day. But just any forward movement is better than no forward movement, right? So just go do your hour or two of research. Go open up your whatever it is, like Robinhood or Acorns or Fidelity or Vanguard. Just whatever one you're comfortable with. Make your first investment and just start watching, even if it's like $50 or $100. I think just that forward momentum, getting comfortable with it, seeing how the stock market behaves, seeing how investments work, and continuing to learn along the way is how you will win over the long term.
Powerful.
Powerful.
Yeah, I know some people on YouTube, and I see some of the earners are asking about NKLA. We are very aware of it. We know that it went up. We know it went up 103%. We are watching very closely. We might talk about it next week. We are very aware. Trust me, we are very aware.
Yeah, and I was for the stock club members. You got when it was TVIQ, you guys are already in at 22. So even with that, it's like when you guys are trading, and this will be another trading tip, and we'll end here. Don't always chase the hot thing, because often when people are in that move early and you're hearing about it late, and everyone in the barbershop, everyone on Facebook, everyone on Twitter is talking about these stocks. As a retail trader, they are using your entries as their exits. Be very careful. You don't always want to go with the herd. Even though Buffett and Icon and everyone and Jeremy, I have talked about indexes, no one wants to do it because it's boring. I want you to have freedom, not excitement. If you need excitement, you can go have sex. I want you to have guaranteed return. And that's way more fun. Or go to Vegas if you want to gamble, right? But as far as NKLA, it's too high to get in. So you have to know on every single investment, it either has to be time-based. That's why everyone tells you, index fund, long-term investing, time-based exit 30 to 40 years. You know how much money you're going to end up having. So be very careful with chasing a lot of pump and dumps. Same thing with Genius Brands. But Jeremy, like I said, I've been a long-time follower of your page. I love your movement, and especially, being well-to-do. I mean, San Diego is expensive. My cousin used to live in La Jolla, so I know how beautiful and pricey.
Oh yeah, that's the really nice area.
Yeah, that's a beautiful area. But even to have the courage to tell people to live below your means after you've acquired money, because that's not very popular on Instagram, because everyone's renting cars and renting girls at a fake mansion that they don't own, right? Thank you for pushing that narrative as well. Where can people find you on social? Because I know a lot of people have been asking.
Yeah, thanks. Most of the magic is on Instagram at Personal Finance Club. It looks like this on my shirt. And what you were saying about the slow thing, Warren Buffett has this great quote where he breaks down, if you invested, he's like, when I opened my company, if you just bought an index fund for $10,000 and just held it until today, it would be worth like 40 million or something like that. Just some crazy number.
Yeah.
And then someone asked, why doesn't everyone do that? And he said, because nobody wants to get rich slowly. Everyone's like chasing the thing they want overnight. But if you just take the long term, that's how you build real generational wealth.
Slow and steady wins the race. Okay, so earners, I'm gonna do one giveaway for you for the Stock Club Scholarship. YouTube, I'm gonna do one giveaway. So I'm gonna give more value, as I always try and do. So this is the full one, even though my team is gonna kill me when we get off here. Type the number one reason you want to be financially free in YouTube and in Zoom, and I'll pick one person from each.
There you have it.
There you have it.
Giveaway.
Jeremy, we appreciate you being a part of this discussion tonight, man. A lot of gems will drop. We appreciate you. Wholeheartedly. Thank you for coming on, bro.
Thanks. This was awesome, and your audience is awesome too. I love the questions. I love the comments. You guys have a serious audience going here. I love it.
Real community. It's a real
appreciate
community,
that.
man.
We're probably
Thank
going to
you.
relocate. We're bringing a whole Earn Your Leisure team to Los Angeles this summer for about 30 days. So
Yeah, y'all heard it here first.
If you're in Southern California, maybe we can link up.
Yeah, no, I'll make that drive. It's a short drive for me.
Maybe we could go to San Diego. Actually, we'll be out
that
there.
might not be a
We'll
bad
be out
idea.
there for a month. So we got to figure something out.
Jeremy, thank you. I'll be contacting you later tonight, but I thank you for being on. I greatly appreciate it. You did an amazing job.
Thanks for inviting me. This is awesome.
Nah, thank you. Appreciate it. Yes, before we wrap this up, so yeah, if you want to have a scholarship to Ian's Stock Club, as he said, the instructions in YouTube, just type in why you would like it, right?
Mm-hmm.
And
Yeah.
the same with the Zoom for our EYL University members. EYL University, once again, 40% off discount that we're running. And I think we're going to do a scholarship for a couple college kids
Yeah.
as well.
That's amazing.
And we got some other stuff that we're working on, community give backs. But if you're interested, code is earners, EYL University, 40% off. It's impossible not to get your money's worth.
Within the first day.
Price is going up July 1st for sure. So yeah, Ian, any closing words?
Yeah, I want to give the winners out right here so they don't think we capping about the giveaway. So Benjamin, I'm sorry I don't know how to say your name. Colangeles, you said you want to help change your family tree. Email me at ian@joinredpanda. That will be our YouTube winner. I greatly appreciate you. You're absolutely amazing. And now I'm going to go to the amazing earners. I love you guys so much.
Hold on, we got to shout out Jermaine Walker. Shout out to Jermaine Walker on the super
I
chat.
can't say that. Yes.
Yo, man, he's showing some crazy love. It's blowing up over there. Jermaine, we appreciate the love, bro. So wholeheartedly.
And then Ernest and the earners, I appreciate you. Send me an email to ian@joinredpanda, and you are our second scholarship winner. So thank you guys for making the show amazing. I know investing can be tricky. I'm just sharing with you what I wish I knew from day one. If you need a book to read Money Master the Game. I think it's the best book that breaks down every part of investing for you. I have no affiliation with Tony, but y'all go tag Tony. So maybe this show and him can do something in the future. You got to ask for what you want, right?
Yeah.
So read that book. If you want the All-Star team, any index is great. So any of ones from Vanguard. So VOO is popular. There's a ton of other ones you can look at. Start there. For those of you that are up 80%, 100%, 300%, my God, you don't know what kind of blessing you have had by taking action. Because every other market, when we slow down, is going to be easy to pick investments because there's not as much noise in the place. So thank you guys for an amazing show. Troy, Rashad, I love y'all dearly. Michael, Jamal, I appreciate it. Rashad, I hope you feel better. And thank you guys for making a dream of mine come true. I appreciate y'all.
Of course, man.
For sure. So, all right, family.
Yeah, y'all know what tomorrow is. It's Tuesday, so another episode will be out.
Coming out Tuesday. Shout out to Ronnie Brown. Dope episode.
Amazing lady.
Super dope. She's making a ton of money. She's become a millionaire online, selling products online. So this is episode. Ronnie Brown. She's from DC.
I haven't heard of her. I gotta check her out.
Her personality is golden, man. You'll love it.
She's big. So all influencers, aspiring influencers, business owners, anybody that's trying to make a profit on social media, online, definitely need to check out.
Yeah, her story is compelling. Started at a mother at 16, was told she wasn't gonna be anything, and that just drove her to just go crazy, man.
That's show your power and determination, though. That's
man, it's amazing. It's amazing. Her story is gonna be incredible. And then we got another episode dropping on Friday, so we got 2 episodes this week.
Oh yeah, the Friday episode is a real crazy one. Jamila Davis, you ever heard of her?
No, who's that?
She was on Love and Hip Hop. She was on the Breakfast Club and all that. She's made up. So she was Alpine, New Jersey. That's like where all the rappers live. So she was like the first person to come to Alpine like years ago. And long story short, she went to jail for 12 years for
9 years on a 12-year sentence.
Yeah, for bank fraud. I think it was bank fraud, right?
Yeah.
Bank fraud. But it's so crazy because she got tied into Lehman Brothers. she was working with a mortgage broker that had a direct pipeline with Lehman Brothers. So it's a whole white collar crime. They call it pink collar. It's a whole white collar crime, but the guy, she got more time
than anybody.
Than the guys at Lehman or anybody.
Anybody. So only one during that financial crisis of 2008, right? Only one person went to jail from one of the big banks, right? And he went to jail for I think 1 year. She was sentenced to a 12 years in prison and served 9. She got more than everybody combined. They railroaded her, but her story is so compelling. Y'all gotta check it out this Friday.
Nah, it's crazy. It's like it's really one of those
blow your mind.
Yeah, it's one of those documentary type of episodes that you're gonna be like, this is crazy. So yeah, that's coming out on Friday.
You put up a hell of a flu game, man. So get some rest and therapy.
Yeah,
definitely did.
You know, I had to show up. I had to show everybody on YouTube before we hang up. Please like this video. Please like the video.
Like and share, please.
Yes, take a millisecond and like it. It helps out a lot. Thank you.
Yeah, everybody's tomorrow's Tuesday. Shout out to our brother Wall Street Trapper. Go tune into
Shopping Tuesday. Yeah, shout out Shopping
Tuesdays. I spoke to Wall Street Trapper today. I didn't even have time to talk about. We're gonna talk about the W. Maybe we can talk about that next week with the W recovery or the V. That article I sent you.
Yep.
Yeah, we didn't get. We'll talk about that next week. But all right.
Yo, YouTube, we love y'all. Earners, we love y'all. We'll check y'all out this week.
Stock Club members, 9 p.m. Central, Zoom. I'm gonna drop the link in Telegram, 10 minutes. But you guys are up. You shouldn't have any questions. You guys were in a month before the world knew about it. So I love you guys.
All right, y'all. Be good.
Peace.
Peace.